Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the crazy video because today I get to confront the man who has been warning everyone about the impending car bubble, which according to him has already popped, which means there's a good chance we're already in a recession, and we're about to find out next week on July 28th at 8:30 a.m. when the BEA releases the second quarter advance estimate. So let me rewind and share with you some crazy statistics from KPMG, Consumer Reports, and LendingTree that really blew my mind. And then this video is gonna get really spicy, so smash the like button and subscribe before the economy goes crazy. Here's what's happening. Right now, Americans owe roughly $1.46 trillion in auto loans. That represents 9.4% of all the consumer debt that's out there, right below student loan debt at 10.1%. And this is something that's been happening pretty recently over the last 2 years, because if we zoom out and we look at the data between 1990 and 2021, you could see this spike of 42.4%. That happened pretty recently and in a very short amount of time. Now, between 2020 and 2021 alone, used car payments went up 18.1% from $413 to $488 a month. And in the first quarter of this year, we're now at $503 a month, and that's for used cars alone. Now, according to Moody's analytics of vehicle affordability, a person now needs 41.3 weeks of income to buy a new car in comparison to what was the average, which was only 34. That brings us to today, where people are still paying $10,000 more than they should be. 1 in 12 Americans are more than 90 days late on their car payments, and 8 out of 10 Americans are still overpaying for their cars. 82.2% of new car sales are now sold over MSRP value. And the reason why this number is crazy is because just last year, in January 2021, this number was only 2.8%. And crazier still was that in 2020, that number was 0.3%. So what this means is that now the majority of buyers are overpaying for their cars, leading some people to believe that the car market is in a bubble, which is an even bigger sign that our economy is in trouble. And the reason why some people believe this is because of what are called repo rates. In other words, cars that have been repossessed because the buyer was not able to make their minimum monthly payments and now they're in default. And as of right now, roughly 1 in 8 cars are repossessed, but that number is probably much worse. So the reason why cars specifically are so important to this story is because when economists look at what the odds of a recession might be, they might look at things like GDP levels and the federal funds rate, the inverted yield curve, asset prices like real estate, stocks, commodity prices, treasury bond yields, and other fancy words you've heard of that people use to sound smart all the time. Totally not me. But a lot of that data is mostly backwards looking, and not everyone pays attention to those things because not everybody invests in those assets. But cars is something a lot of people have. And the way people prioritize their car payments tells us a lot about what the economy is doing, because when things go south, cars are one of the first things people stop paying for long before they stop paying for everything else. So in today's video, I want to go visit the person who's in the business of buying cars in the repo market so that he can explain and make sense of everything that's going on and share some data so that we can hopefully better prepare for what could happen next. So let's go see him right now. Lucky Lopez is a local here in town who is in the business of buying and selling cars here in Las Vegas, Nevada. He's one of the first guys on the scene when a car gets repossessed to buy it from a bank or an auction house. He also has a YouTube channel, and he's recently been featured on Barron's, CNN, and most of all, my YouTube channel, because it's the coolest of all these. And what he has to say will blow your mind. All right, so here we have Lucky with us today. Thanks for coming on.
Thank you for having me.
That's even your real name.
It's my OnlyFans.
I knew it. Could you please paint the picture of what's going on in the car market?
As of right now, we're seeing record high default rates. And the reason why we got here is during 2020 and 2021, we saw loan origination, which is a fancy term for new loans, skyrocket. Now, the reason why this is so significant is because it coincides. Is it coincides?
It's a word. Okay.
That it coincided with the stimulus payments. Now, when this money hit the market, car sales just shot up. Now, normally with repos, there's no rhythm, there's no pattern, there's nothing like that. But what we're currently seeing now is that a lot of the loans that are going up for repo have the same origination dates of 2020 and 2021. And it's because a lot of these banks got really loose with their lending and were lending out way too much LTV.
All right, so can you please explain what LTV means? Because I'm sure most people have never heard of that phrase.
Sure. So LTV is is loan to value. Most subprime borrowers lend 80 to 90% of a vehicle's value. So if your car is worth $10,000, they'll loan up to 90% of that. But during the pandemic, because of the chip shortage and the increase of used car prices, they loosened up their lending and they started going up to 145% of LTV. So now that $10,000 car, they can get a loan all the way up to $14,500, even if the car is not even worth it. And the most scary thing is that 96% of the borrowers didn't have any type of income verification.
Wow, and now that interest rates are going up, now that stimulus has dried up and the economy's going down, we find ourselves here.
Exactly.
Check this out. Loans that are past due on a state-by-state level have been skyrocketing. Right now, the best state in the whole country with the lowest amount of loans past due is actually Utah, with only 4.5% of all auto loans that are 30 days past due. But that is the best state in the whole country. Another example is New York, which is the 10th worst state in the whole country at 10.1% of all loans at 30 days past due, which means roughly 1 out of every 10 people in New York that are walking here have stopped paying for their cars. But the worst state in the whole country, may or may not surprise you, is actually Washington, D.C. at roughly 23.4% of auto loans that are 30 days past due, which means almost 1 out of every 4 people in the state of Washington, D.C. have decided to stop paying for their auto loans. All right, so can you please explain exactly how we got to this point?
Well, it's your good buddy, Papa Powell.
I love Papa Powell. Papa bless.
Well, to expand, I guess, a little bit more on that, in March of 2020, we got the CARES Act that pumped $2.2 trillion in the market, and that's how it all started. On April of 2020, car sales fell by 46%. By the summer of 2020, rental car companies were facing bankruptcy. Suppliers started telling people that there was a chip shortage, which is also around the time that the second round of stimulus came out for $900 billion. By January of 2021, automakers stopped producing as many cars, so supply started to dwindle down. March of 2021, the American Rescue Plan injected another $1.9 trillion into the economy, and by April 2021, sales started to exceed supply and car prices skyrocketed. And that's when people got their stimulus checks. Now, as a dealer, we use this matrix called days on the lot. And as you can see here from the graph, in April 1st of 2020 was at its peak of 53 days. Now, this is during the pandemic when everything was shut down, people were afraid to buy, and they weren't doing anything. But as people got their stimulus money, they rushed to the dealerships to buy overpriced inventory. And as you can see from the graph, the average days on lot started to shorten.
But what the data doesn't show, you're saying, is the repo market. And that's because when banks give loans to people to buy a car, those loans then get packaged up and sold off, kind of like they did in 2008 for housing. They sell them off, they rate them, not always accurately, and then they sell them off to big investors and hedge funds.
Correct. What most people don't know is that when this happens, as a bank, they have to report late payments and repos, part of the FDIC regulation. But as a private investor or as a hedge fund, they're not allowed to share that information because of the Fair Credit Act.
Now, the Fair Credit Act says that consumer information cannot be provided to anyone without a purpose specified in the act, which is a fancy way of saying they're not just going to give out your financial information to anyone that asks. And this is supposed to protect us as consumers from big companies like banks and dealerships saying, look at Andre over here, he can't even afford his Toyota Corolla. His credit score is like 600. Nobody give him a loan. Get it? Malone? Like a loan? Charlie. We're getting old. That's why it's partially difficult to find data and information about all this because it's not publicly shared.
So let's go ahead and do this. Let's go out and see the data in real life.
I'm down.
This is going to be super cool because we're going to show you guys something that nobody has access to. You have to either be a dealer or a banker to go to these repo lots or these auctions. Now, we're going to give you a little peek behind the curtains and show you exactly what we do. We're going to the staging area. This is where they line up all the cars for the weekly sale. So remember how we talked about how the banks are smart and they only trickle out cars? So the cars here in this front section are only the ones that are going for sale this week. The rest of the reserves is in the far back.
All right, so behind me is a ton of cars. What are we looking at right there?
So this is a staging area for the cars that are going up for auction this week. So if you look behind us, you can see hundreds of cars. Now this is only a small piece. Remember, the banks are really smart. A lot of the cars are being held back there, and they're only going to trickle out a few every now and then, so this way they don't crash the market.
All right, so what we just showed you before was the front end of the building, which is roughly 20% of the inventory. Right here, where we're driving, will take about an hour to just walk. It'll take 10 minutes to drive through, and this represents the other 80% of the inventory.
Normally we're going to walk this, but this would be a 1 hour video. So we're going to get in the car and we're actually going to drive just to show you how massive this is. So as of right here, this is the actual point where they're selling the cars. Everything back this way is a staging area. It's probably going to take us about maybe 10 minutes going about 20 miles an hour to get all the way to the back. So there's a fresh pickup.
So right there, you see the car right there? They're literally repossessing a car right as we're driving. So we are literally being followed by security right now behind us. Look, that's a security truck right there. And what kind of cars do they typically have in there? It's just like any car? Exotics?
Yeah, it's exotic cars, it's regular cars, it's boats, it's jet skis, it's motorhomes, RVs, anything you could think of that can be possibly repossessed is in this lot.
Anything that can be taken is in there.
100%.
All right, so that was pretty crazy. So what I saw was that there was a long line of cars, which is kind of contrary to what we're told, which is that there's a supply shortage and that there's no inventory, but that's not at all what I saw.
There's definitely not a shortage. People are overpaying for cars. The banks are smart. They can be sitting on 5,000 repos. They're not going to dump them all at the market at one time. They're going to control that flow and trickle out those cars slowly, so this way the market doesn't crash.
So maybe a couple hundred every week.
Correct.
Kind of like the diamond industry where diamonds are a girl's best friend, but inventory flows are a bank's best friend.
You know, what's even crazier is that Manheim, the auction we were at, tells me as a dealer how much we're going to pay for cars. Kelley Blue Book tells the banks how much they can lend on vehicles. And Auto Trader tells the public on how much they should pay for cars. And all three of these companies are owned by Cox Automotive.
So it's a monopoly, basically.
100%.
It's kind of like the Luxottica, but for cars. Google Luxottica if you ever have a chance. It's basically a legal monopoly. Now, I will say that there's one argument made against this, saying that, well, perhaps your stories are more anecdotal in the sense that maybe you're just dealing with subprime borrowers, the people with lower incomes. Of course, those are the people that are gonna have the hardest time paying because of their lower incomes. But you're saying
that it's not just the subprime people, it's the prime borrowers. That's what's scaring people. Since last year, the repo rate has almost doubled from 2.1% to 4%.
Which doesn't sound like a lot, but that's almost a 100% increase.
Right? I mean, these people could afford it at the time they had good credit, but unfortunately due to inflation, maybe the rent has doubled, gas has definitely doubled, and the affordability of these vehicles is no longer feasible. So now you're at a point where you have a depreciating asset where you're upside down 40%. And you gotta remember, 96% of these people didn't have their income verified. So now we have a 2008 housing crisis where people are gonna be upside down in their cars instead of their houses, and they may just walk away from it.
What would you say for people trying to buy a car right now?
I would definitely wait. I mean, I know if you need a car, go get one, but always get it pre-approved from your credit union. Do not go to the dealership and get financing because you'll get taxed with all kinds of stuff. And also take your time and buy the right car. And don't buy anything that's super expensive because as the market starts to dip, we're expecting about a 20% decrease. And you gotta remember, if you buy a $10,000, $15,000 car, that decrease is gonna be very minimal, a couple $100. But if you buy a $60,000, $70,000, or even a $100,000 Escalade, you're talking $10,000, $20,000. So be smart, be patient, and don't be in a rush to get your car.
And when was the market kind of estimated to somewhat recover and the supply and demand kind of balance out?
It's been a mixed bag. Everybody's kind of given their 2 cents. My professional belief is that it's going to be within 6 to 8 months. Is the market's going to stabilize, prices are going to come down, and the flow of new vehicles are going to hit the market, and it should stabilize quite a bit.
And I've seen estimates that say that it'll recover by the end of 2022 or maybe as late as 2023.
Correct. That's what most people are saying.
Thank you for coming on. And what's the scam?
The scam is the car market.
The scam's the car market. And what are you peddling?
My friend, I sell you car.
Go check out Lucky's YouTube channel. He's a local here in Vegas. Subscribe to him. He's awesome. Thanks for coming on.
Thank you for having me.
As always, have a wonderful rest of your day. Smash the like button. Subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin right here. Please do not keep your crypto online. Just grab the money while it's there and then immediately take it off and keep it on cold storage. Also grab your free stocks. Links are down below and then go track them automatically with the spreadsheet link down below in my Patreon. Love you. Thank you so much for watching. I'll see you back here on Monday, Friday, sometimes Wednesday. I'll see you soon. Bye-bye.